Welcome to the March 22nd edition of Market Thoughts. I'm Dave with Lighthouse. We're not even through the first weekend of the NCAA tournament, and I'm already in last place in our office bracket. March madness for sure. It's also been March madness in the grain markets. We'll talk about this chart, what we think happens next, what to do about it in a second. But first, self-serving commercial. As always, just a quick stop this week over what's going to be a new analytics chart look in our daily emails and daily text that you receive. It's going to take our price signal and market gauges and our new classifier data released in January and put it all into one easy to read visual. If you're just recapping this, this is our signal that has been highly useful ever since it was launched. We're on version 3, soon to be version 4 of that. Our market gauges that provide this extra context based on these criteria. And then the classifier says, I'm going to take all that data, I'm going to find similar days in the past that were like this, and I'm going to predict how likely it is that price falls over the next 20 days based on this signal and market gauge data. In this rendering, for example, signal score of 85 above the sell threshold. Look at these high market gauges, and the classifier saying, given that setup, it's 90% likely that price would fall over the next 20 days. This is just a rendering. It would be incredibly rare to ever get that high a degree of probability, but you get the point here. This would give you, in a matter of seconds, you can look at these analytics and make a quick decision on, does it make sense at all to sell grain or not today, or to buy grain or not? So that's exciting improvement on our already robust analytics. And the next phase of that, we're going to want you to start consuming this in our Lighthouse app that we launched earlier this year. That app already has all your grain data, your contracts, your hedge percentages, your average prices. It's not a bad place to spend some time anyhow. But going forward, we're having so many issues with spam guards and things like that around email and text that about half of our clients are only getting this content half of the time, if you will. And rather than fight that forever, we're eventually just going to say this is already in the app. If you go into your Lighthouse app right now, as we're speaking, you'll see this video that you're watching. You'll see all the emails, all the next trade segments, everything else. So that's a natural place to get it anyhow. That's what we're going to start moving to. So if you haven't already, make sure you download the Lighthouse app. Eventually, that's where you need to go to get this sort of hard-hitting insight you've come to rely on. So, all right, let's look at weekly changes. May corn lost $0.0175 on the week to close at 465.5. Doesn't feel like that's what happened. It felt like something much more significant, but here's why. Big washout on Monday alongside the soybean loss. More on that in a minute. But the one takeaway on this chart is you're still holding to a pretty nice, well-defined uptrend. If I flip out to a weekly, it's even more pronounced. You're well off the bottom of this uptrend. So it's ominous in a lot of other ways when we get into unpacking the rest of this on corn, but your chart still looks good. Just your traditional chart view still looks pretty bullish here on corn. May soybeans, a little different take. Here's how it looks weekly. Lost 64 cents to close at 11.6125. Somehow, if you fan out to the daily chart, it's even worse, because here's what happened Monday. Lost 70 cents. That's limit down. It actually was more like 78 cents that you lost. That was the largest one-day loss for soybeans since late February of 2022. More on this later, or how this ties in. That was about 2 weeks into the start of the Ukraine-Russia war. So recall that we've been talking about how war premium gets priced in quickly in these markets just based on the limited sample size that we have. Something very similar happened in 2022, about 2 weeks into the Ukraine situation. You had a washout that flushed out all the week longs in the soybean market, and you eventually clawed back, but you never did get above that spike high, at least in that 2022 example, which would say 1238.75 high doesn't look very probable to get eclipsed in the short term here. So that's what we learned on soybeans. If we look to spring wheat, little funky chart overall. If we fan out to weekly, lost 17.5 cents on the week and down considerably from its spike high 2 Mondays ago. Will be 3 Mondays ago tomorrow. Here's how this looks. This is actually a chart view that looks pretty ominous right now. You've actually had a little bit of consolidation, never made it even close to your spike high broke out lower from this consolidation, recovered, but still didn't get even back to the top of your recent consolidation, and then the big loss Friday. So this wheat chart doesn't look good. It looks poised for more losses. Couldn't have more conflicting views after a week of trading. Corn still looks really strong chart wise. Soybeans look like they put in a major high, but will try to at least revisit that high. And wheat looks like it's actually started a downtrend. So another week from now, it'll be interesting to see what happens next, because these can't all be true together. One of those themes has got to win out. All right, one thing I didn't want to, just getting back to March Madness and how much the Iran war has scrambled our brains. Normally in March, we're talking about St. Paddy's Day and planting intentions, and St. Paddy's Day has come and passed without me wearing any green, and planting intentions is little over a week out, and we barely talked about it. Here's what you have going into this. This is normally the biggest, or one of the two biggest market moving reports of the year. This was 2025 planted acres. This is Ag Forum, what the USDA said. Here's what we think is going to happen. What do we actually get for planting intentions? Something happening parallel to this is urea price continues to surge. If you look at corn margins, they've actually lost ground despite the rally if you were to take nitrogen fertilizer price at the market today. So if we go back to trying to make sense of planting intentions, was this the number before time? And is it getting, before the war broke out, is it getting smaller based on, will people back away more because of the urea situation? I think another thing we got to consider is there's fringe cotton and rice acres that are likely going to flow into this number too. The idea that you're going to be lower than a year ago on total acres, does that pass the smell test? We'll do a deeper dive next week, but just get this on your radar. Planting intentions are a huge wild card coming up here at the end of the month. Okay, so latest on the Iran conflict. If you're just following the headlines and synthesizing them, it appears to not be going well, I guess, for anyone. You're having attacks on major energy infrastructure and retaliation, heavy bombing still inside Iran, retaliatory strikes from Iran to countries all around the Middle East that still appears to be escalating. I think a couple things that are happening, if you try to make sense of what the signal is in the noise, you saw a rhetoric shift towards the end of last week that more countries or the world in general is aligned with the idea that we got to get oil flowing through the Strait of Hormuz, that Iran can't just unilaterally stop this from happening. We got to step up and do that. So again, this could look foolish, but it looked cautiously like going home into the weekend that maybe we're starting to turn a corner on that front. Crude oil, at least U.S. crude, still remains well below its recent highs. At the same time, as we noted last week, as we talked about when we highlighted soybean changes, are few similar case studies, mainly the Ukraine-Russia war, suggests that your war premium gets built in quickly into these grain markets over 2 to 4 weeks at most, and we're already at the 3-week mark. I don't think, short of drastic further escalation, I think if we take the status quo that we have now, $98 give or take crude oil, I think whatever premium that's worth in the grain market is built in already. So, and then conversely, if you were to rapidly de-escalate and see energy prices collapse, that certainly would not be helpful to grains. So that's where we're at on the big headline grabbing front. We think it's mostly priced into corn. Could look foolish, but that's what we think now. So on the other front, you still have some strong overall demand stories. You've got Chinese upcoming meeting, and you've got biofuels, supposedly a big signing ceremony in DC next week, though we've heard conflicting stories about that. But soybean oil has been surging even pre-Iran war, just based on the specter of significant increase in renewable diesel volume for 2026. That's been a poorly kept secret. There's been a lot of rumors and leaks, but no official announcement. I don't think we're going to get that announcement next week. And then on the China front, this entire soybean rally, if we go back to soybean chart and fan out to a daily here, this whole thing kicked off right here based on a social media post about a very good phone call where China supposedly suggested they would maybe take another 8 million metric ton of old crop beans. There has been no discussion on that front since, no confirmation, no movement in the cash markets, etc. And now that meeting that was supposed to happen the end of this month is now being kicked out till possibly late April. Not in a confrontational way necessarily, but in any event, just it's not happening yet. So your other stories, I guess I would say biofuels and the potential additional China purchases are built into this price too. We've been trading this concept of it happened for the last over a month. And this is all leading to a broader point. I think we're getting these stories priced in, even though they're still bullish stories, but they're priced in. So if you look ahead and say futures markets move based on what happens next, I think the strongest thing you have going for you is just you're in a strong seasonal for grains. Charts look good right now, or at least corn does. You have a strong tendency to rally, and you've got a lot of news ahead of you, a lot of weather, etc. But again, if we look at warning signs in all this, as we noted, the bullish news that we've been moving these markets on, we think a lot of it, the Iran war, the biofuels, the Chinese trade, we need something fresh there. None of those stories right now have enough to necessarily usher in this next leg higher. And meanwhile, you've got the warning signs that we've been talking about. Basis and spreads have gotten worse during this rally. Cash markets, at least on the front end, are not needing this extra grain at these higher prices at all. And then, as we alluded to, we showed last week price to stocks to use, how when all three commodities had gotten so high, how rare it was for grains to rally. Here's managed money, their combined net long of corn, soybeans, and wheat. You're starting to almost get into all-time long territory, and virtually every one of these spikes is associated with a significant subsequent decline in price. Your only outliers are your transition in 2020, where you hit this level early and prices stayed high and kept rallying all through the winter. Otherwise, when you hit up into this range, when you're north of 400,000 contracts net long across all three commodities, that's not typically associated with a major continued rally. So what you land with, and if you hit on signal engages too, what you land with is you basically have, in a scenario like this where you've rallied to this level, you've got this high a managed money net position, you've discounted these fundamental stories that were driving it, you've priced them in other words, you've got signal and market gauges where they're at. When you look at all that, there's really only 1 year where you got to that point in this stage of the year and kept going on a rally, and that was 2008. We've been talking, others are starting to glom onto this too, but we've been talking about the 2008 comparison since all the way back at the start of the Iran situation. You could see CRB, just basket of all commodities, at a lower average price, but it's tracking similar. It's tracking similar going all the way back to last fall. Here's what happened in 2008. You kept surging all the way to June, and then obviously epic collapse. So this is one possible path forward. The inflection points in 08 were way on both energy and biofuels were orders of magnitude bigger than they are this year, but it was still a similar theme of inflation, energy, biofuels. We don't think this is most probable. It's just giving you a scenario of what could happen, because otherwise, if you look at basically any other scenario, you're at, other than it's just too early in the year, you're at a significant high. So if we look at corn today, you're above a sell signal. Your market gauge is 81, 100, 80, 79. Only seasonal is not up into the upper echelon on market gauge. And soybean gauge has fallen some now with the collapse in price, but prior to that, it was the same exact thing, ultra high signal and market gauges. So where you sit today is, if you go back to the start of the year, we said it's very probable corn and beans have at least a 10% rally. $5, just under $5 D's corn, 11.70 no beans. That checks those boxes. We also said if you get to those price levels, you've got profit. You've got nice profit on corn, and you've got decent profit on soybeans. It checks those boxes. Now we're looking around this landscape and saying, okay, I don't like that it's only March. I don't like the uncertainty of the Iran situation. That doesn't fit. But I've got all these other analytics saying that this is not only have I achieved my long-term price target and I've achieved my margin goal, or at least I have profitability. Maybe I haven't achieved my outright wish list goal, but I'm getting all this nudging to say sell. This definitely fits, as we've been saying, a risk management objective. And this is a textbook spot too for on all three commodities entering into strategies that fix these prices. In the case of new crop corn and beans, they're at the highest price for the new crop contract in 2 years. In the case of wheat, the highest price for nearby wheat on its high is the highest price for nearby wheat in 2.5 years. Risk management strategies that at least protect that downside or lock in those prices while re-owning with calls or something like that. You're definitely at a spot here where you're getting a strong analytics nudge. The analytics are saying the only time in modern history that if you would have done that you would have been just straight up wrong would have been 2008. That's relatively low probability versus the rest of the time this would have been the right move in spades. And even the 2008 scenario saw a significant continued rally followed by the most epic collapse we've ever seen. So when we sort through all this right now, this is definitely a spot to make sure you've gotten done what you want to on your risk management plan at this stage in the rally. For a lot of us, that has happened already. The nice thing is they've given us several days to do this and get done what we wanted to. But that's where we're at this week. We'll see what the last week of March brings.